Your thoughts on this yesterday after the close was it's not done yet. Why?
Right. I don't think it's done. Now, I don't know that we're going to see another day like that with such a big swing. But the reason I don't think it's done is because that didn't happen where we need to bounce back from a one-time shock, right? That wasn't a one-time event that we're trying to digest. This entire thing is a digestion process of a new environment that we're not conditioned for. So there are a lot more steps that we still have to take. We're going to hear from the Fed tomorrow, obviously, but I wouldn't expect anything earth-shattering to come out of their mouths tomorrow. And then there's a long period of time between tomorrow and that next March 16th meeting where we have to kind of sit around and wait to find out what they're going to do, how quickly they're going to do it, and whether or not the market's going to think that they are behind the eight ball. Now, we talk about this all the time about how the Fed maybe waited too long. I don't think we would have had a different reaction if they started all of this back in August or September. We still would have had this correction at some point. So now we're in this sort of waiting game of, was it too long? Can we still get through this and come out on the other side in a positive way? And I think we can, but it's going to be painful along that route.
People are pretty conditioned to buy the dips. That's been the case for years. And you're not opposed to that. You're just saying don't spend it all in one place, right?
Yeah, don't spend all your cash in one day, and that's because I don't think we're done with this yet. And also, don't spend all your cash on one sector or on a handful of names. I think as we come out of this, we're still not going to go back into a period where there's this huge liquidity-driven multiple expansion. So you still have to pay attention to quality. You still have to pay attention to valuations. And the earnings seasons in 2022 are going to matter a lot more than they have for the last 18 months. I think investors are going to pay very close attention to any guidance that's lowered and any misses that occur. So you want to make sure that you're buying the companies that have that power with strong earnings.
It's early on, but the numbers that we've gotten so far have been pretty good when it comes to the earnings today, and banks, some other places too.
Yeah, they have been, and we're on track to still have another up 20% growth quarter in earnings. But as we start the earnings seasons of 2022, that comes down dramatically. Now, it's just that we're conditioned to be hearing 20, 30% earnings growth. And now we're going to hear things that are closer to that 10% range. So it feels like it's a disappointment. But in reality, 10% growth in earnings is still pretty good. And that would be healthy at this point in the cycle. It's just that we have to start getting used to hearing different numbers and looking into a different rate picture.
People are pretty keyed up about the technology stocks. We're going to hear from Microsoft tonight. But you're looking at a couple other areas, industrials and healthcare, that you think are safer places to buy.
Yeah, and look, I still would be waiting this out a little bit because I think we're going to bump around a little bit here. But if you must put your money to work, if you must buy something, I would buy the sectors that aren't quite as sensitive to rates. So things like industrials, things like healthcare. Don't go into the stuff that's so dependent on these daily moves.